Ask 10 traders for the best candlestick pattern, and 9 of them will name the engulfing candle. It is ranked 84th out of 103. Somebody actually measured this. Thomas Bulkowski tested every documented candlestick pattern across thousands of charts and ranked them by what happens after the pattern completes, not by how often they get taught. This video is the top 10 of that list, and every chapter gives you the same 4 things: what it looks like, what the number says, what the number does not say, and the mistake almost everyone makes with it. So here is what is coming. 10 patterns. Most of them are not the famous ones. We start with number 1. It is called a bearish 3-line strike, and the name is wrong. In a downtrend that is already running, 3 candles close lower, one after another. The second undercuts the first. The third undercuts the second. Then a 4th candle opens below all of them and closes above the open of the first. Here's what that actually means. Somebody measured this pattern across thousands of charts. It is ranked first out of 103. And in 84% of cases, price went up afterwards, not down. 3 rules before you trust it. 1. All 3 candles must close lower than the one before. 2. The 4th opens below the 3rd and closes above the 1st. 3. It has to happen after a real decline, not inside a range. And the mistake almost everyone makes, trading the name instead of the number. The word bearish is a label, not a measurement. That was the bearish 3-line strike. Ranked first out of 103, and it goes up 84% of the time. Number 2 is the same shape upside down, and it is the rarest pattern in this video. It is called a 3-line strike, and it looks like a reversal. In an uptrend that is already running, 3 candles close higher, one after another. The second takes out the first. The third takes out the second. Then a 4th candle opens above them all, and closes below the open of the first. Here's what that actually means. That 4th candle is not new selling. It is 3 candles of profit taken in one go. The buyers who were late finally get their price, and the trend picks up again within a few candles. 3 rules before you trust it. 1. All 3 candles must close higher than the one before. 2. The 4th opens above the 3rd and closes below the 1st. 3. The strike candle carries the volume. And the mistake almost everyone makes, shorting the strike candle. It is the loudest candle on the chart and the wrong one to trade. That was the bullish 3-line strike. Rank 2, and it acts as a bearish reversal 65% of the time. Number 3 needs no trick at all. It is simply the one that ends rallies. It is called 3 black crows. 3 down candles in a row. Each one opens inside the body of the candle before it and closes lower than the last. The lower wicks stay small. Here is what that actually means. Every session opened with hope and closed without it. Small lower wicks mean the dip was never bought. This is not one bad day. This is 3 in a row. Selling that repeats is distribution, not panic. 3 rules before you trust it. 1. Each close must be lower than the one before. 2. Each candle opens inside the previous body. 3. Lower wicks stay short. And the mistake almost everyone makes, shorting the 3rd crow. By then, the move is stretched and your stop sits far above. A pattern tells you who took control. It does not promise you a good price. That was the 3 black crows. Rank 3, and a bearish reversal 78% of the time. Number 4 does the same job at the top of a rally, and it uses a gap to do it. It is called an evening star. 3 candles at the top. First, a long up candle, buying in control. Then a small candle that gaps higher and goes almost nowhere. Then a long down candle that closes deep into the first one. Here's what that actually means. The middle candle is the warning. Price reached higher and nobody followed. The 3rd candle confirms that the last buyers were the highest bidders and there was nobody behind them. 3 rules before you trust it. 1. The middle body must be small. 2. The The third candle has to close below the midpoint of the first. 3. It has to appear after a real advance. And the mistake almost everyone makes, ignoring the middle candle because it looks boring. That boring candle is the entire signal.
That was the evening star. Rank 4, bearish, 72% of the time. Number 5 is not a reversal at all, and it still outranks almost everything you have been taught. It is called an upside Tasuki Gap, and it is 3 candles. In an uptrend that has been running, one candle closes higher, then the next opens above its high and leaves a gap. The third candle falls back into that gap, but it does not close it. Here's what that actually means. The gap is a stretch of price where nobody traded. The pullback asks whether anyone wants to sell it back, and the sellers run out before the gap is filled. 3 rules before you trust it. 1. The gap has to be real, wicks included. 2. The third candle stays inside the gap. 3. The 2 rising candles are about the same size. And the mistake almost everyone makes, buying the moment the gap appears. The pattern is not finished until the third candle closes. That was the upside Tasuki Gap. Rank 5, and it continues the trend 57% of the time. Number 6 has a name that promises the opposite of what it actually does.
It is called an inverted hammer. One candle, a small body sitting at the bottom, and a long wick above it. Price pushed up hard during the session, then gave all of it back before the close. Here is what that actually means. This is the same shape as a shooting star. The difference is where it stands, not how it looks. After a long decline, an attempt that fails is still an attempt. Sellers had every reason to press lower and did not. 3 rules before you trust it. 1. The upper wick has to be at least twice the body. 2. It has to appear after a real decline, not inside a range. 3. The next candle must close above it. And the mistake almost everyone makes, buying the wick itself. On its own, this candle is a failed rally. Only the candle after it turns a failure into a floor.
That was the inverted hammer. Rank 6, and this is the strangest number on the list. It acts as a bearish continuation 65% of the time. Number 7 is the one you will see most often. It is called a falling window, and it is a gap with a rule. In a downtrend that is already moving, one candle prints its low, and the next candle never trades back up to it. The space between them is empty. Nobody agreed on a price in there. Here's what that actually means. A window is not a mistake in the data. It is a price range that everybody skipped, and it becomes resistance on the way back up. The fall continues 67% of the time, and this is one of the most common patterns there is. 3 rules before you trust it. 1. Compare the low to the high, not the bodies. 2. The window has to stay open. Price must not close it immediately. 3. It counts inside a trend, not on a news candle. And the mistake almost everyone makes, expecting every gap to be filled. A quarter of them stop inside the window and go the other way. Pattern 38 of 50. That was the falling window. Rank 7, a bearish continuation 67% of the time, and the most common pattern in this video. Number 8 is also in the top 10, and every book teaches it backwards. It is called a matching low, and it is in the top 10. In a downtrend that has been running, one falling candle closes at its low. The next falling candle closes at exactly the same price. 2 closes on the same line, no wick underneath either of them. Here's what that actually means. Every book calls this a bullish reversal. Somebody tested it, and it is ranked 8th out of 103, which is the top 10 of every candlestick pattern there is. But the direction is the other way. Price kept falling 61% of the time. 3 rules before you trust it. 1. Both closes have to match, not just come close. 2. Both candles fall and both close at their low. 3. It has to sit inside a decline that already exists. and the mistake almost everyone makes, buying the second close. A shared low is a shelf, and shelves break downward more often than not. That was the matching low. Rank 8, and the measurement says it keeps falling 61% of the time. Number 9 is the one you might see twice in a year.
It is called an abandoned baby. 3 candles. First, a down candle in a falling market, then a doji that gaps below it and touches nothing, then an up candle that gaps back above the doji. Here is what that actually means. The middle session traded in its own pocket of price, away from everything around it. It opened and closed at the same level, so the panic found no seller and no buyer. Then the market reopened above it and never went back. 3 rules before you trust it. 1. The doji must gap clear on both sides, wicks included. 2. It has to follow a real decline. 3. The third candle must close well inside the first body. And the mistake almost everyone makes, calling it an abandoned baby when the wicks overlap. Overlapping wicks mean there was no gap. No gap, no abandonment.
That was the abandoned baby. Rank 9, a bullish reversal 70% of the time, and it is almost never on the chart. Number 10 is the last one, and it is the gap that never gets filled. It is called 2 black gapping, and it is a continuation. In a downtrend that is already underway, price gaps below the low of the last candle. Then 2 falling candles print in a row, and neither of them trades back up into the gap. Here's what that actually means. The gap said the sellers moved first. The 2 candles after it said nobody wanted to argue. It is ranked 10th out of 103, and the decline continued 68% of the time. 3 rules before you trust it. 1. The gap is measured against the low, not the close. 2. Both candles after the gap must close lower. 3. Neither high may reach back into the gap. And the mistake almost everyone makes, waiting for a bounce to sell into. This is the pattern where the bounce does not come. So that is the 10 patterns ranked by measurement instead of by reputation. Every one of them asked you the same 3 questions. Where did it happen? What came before it? And did the next candle agree? And if you remember nothing else from this video, remember that a rank is a measurement, not a promise. It says what happened after thousands of these patterns. It says nothing about the next one. So start with 1. Take the number 1 pattern, open a chart, and count how often it does the opposite of what its name says. That is the work. 1 pattern a day, 60 seconds each on the channel.